Hi everybody, and welcome to Accounting 1. I have a little video here to get us started with Chapter 1. I'm going to do it similar to how I would be doing it in class, and I'm going to talk about some of the concepts and go through some of the practice problems. I'm not going to go through all of the problems that are in your practice demo set, but I'll be going through a lot of them in here. So, when we talk about accounting, most of the people in my classes don't want to be accountants. They're just taking it because accounting is required for all business majors. And so I said, well, why do you think it's required for all business majors? And so we talk a little bit about what accounting is here. Really, accounting is the language of business. It's really an information system, and all business decisions are based on this information. Based on this information. So we collect the information in accounting. And what this means to you, even if you don't want to be an accountant, is that you might not be the one that's collecting the information, but you are going to be the one that's using the information. So even if you're managing people, or you're the marketing person, or whatever you are, you're still going to be making your decisions based on this information. So it's important that you understand the language. It's important that you understand the numbers that you're getting, what they mean, where they come from. I think it's very similar to when I take my car to the mechanic and he says, you need a blah, blah, blah. I have no idea what he's talking about. So I just have to say, okay, because I don't know that language. And so I'm at a distinct disadvantage because I just have to take his word for it because I don't know. So as a manager, you're going to be using this information. You need to make sure you understand what it is so you can make the best decisions. Accounting is really in two groups. There is financial accounting and managerial accounting. So managerial accounting is for internal users. So these are people within the organization. So managers of all the different functional areas, staffing, purchasing, distribution, manufacturing, production, all those types of things. And there is not one right way to do this information. It depends who needs the information, for what purpose they need the information, and so it can vary a lot. Financial accounting, however, is for external users or external stakeholders. So we have, for instance, investors or stockholders or potential stockholders. We have creditors or banks. We have the IRS to whom we pay our taxes. So because these external users are looking at all kinds of different companies, it's very important that everybody does things the same way, so that a potential investor, for example, is comparing apples to apples when he's looking at two different companies, or that everybody's paying fair taxes because everybody's counting things the same way. So for financial accounting, the rules are very, very important. It's very important that we do things the same way in financial accounting. In accounting 1, we're talking about just financial accounting. In accounting 2, in the second half, we get into managerial accounting. So it's more, okay, now we've collected all this information. How do we use this information to make decisions? But we don't get to that until the second half of accounting 2. Let's see. So let's talk about these rules. These rules are really, really important in financial accounting. The set of rules that we use is called GAAP, which stands for Generally Accepted Accounting Principles. And this decides how you depreciate things, what you can call an expense, what's an asset, all these words that we haven't really gotten to yet. But it's very, very specific. There's no black or white in financial accounting, really. These are the rules and you must follow them. In managerial accounting, if you don't do it right, your risk is really just that you're not making good decisions, and quite frankly, if you're not making good decisions, you probably won't be in business long. But with financial accounting, there's legal repercussions to not doing this right. If you're not counting things right, that could be tax evasion. There's all kinds of much more serious ramifications. Well, I guess losing your business is serious. But the group that's behind the generally accepted accounting principles, or GAAP, is the FASB, the Financial Accounting Standards Board. They're the ones who kind of make the rules and enforce them, although the IRS is very involved in that too with certain types. The GAAP works under 4 primary assumptions. One is the economic entity assumption. And this assumes, what we do is we keep our records. The business is a separate economic entity than the owner, all right? So that means I keep the assets of the owner separate from the assets of the business, and I keep the activities of the business separate from the activities of the owner. Even if it's a small business and it has one owner, he can take money out whenever he wants, but we have to keep those activities separate. If we don't, we have no way to actually track the performance of the business. We can't tell how profitable that business is or isn't. We can't tell how much it actually costs us to do whatever it is we do if we have personal things and business things all mixed in together. So we need to keep those separate. So while we're here, we talk about 4 different types of ownership. Sole proprietorship is the most common form of ownership. That means there's just one owner of the business. Similar to that is a partnership, where I have more than one owner. And then we've got a corporation, which is a bunch of owners. Like, that's where we have stockholders. The biggest disadvantage of a sole proprietorship or partnership is what we call unlimited liability. And so that means legally there's not a difference between the business and so we keep track of their activities separately, but legally there's no separation, which means if somebody sues your business, not only can they take the business's assets, but they can take your personal assets as well. Or if the business fails to pay its debts, then the debtors or the creditors can come after your personal assets as well. So while this is very common, it's also extremely risky because a lot of things could happen, and you could lose not just your business, but you could lose your own house, all your own personal savings and all that, which is why we see a lot of times an LLC form. And this is kind of a combination of the two. So a corporation, they're legally separate. So you can't come after the owner's assets or anything like that. The disadvantage of a corporation is what we call double taxation. So the corporation is taxed on its profits. Whatever's left over after that is then turned over to the owners or the stockholders, who are taxed on what they get from the business. So the business pays taxes on that money, and then the owners pay taxes on the money that the business has already paid taxes on. So that's the biggest disadvantage. The LLC kind of gives the best of both worlds. They are separate legally, so you can't come after the owner's personal assets, but it's taxed like a sole proprietorship or a partnership, so it doesn't have that double taxation. There are limits to who can do this. A huge corporation, there's limits in terms of the revenue that you generate. You can't issue stock if you're an LLC. It has a limited lifespan and that kind of stuff. But the book does go through the pros and cons of all the different forms of ownership. So be familiar with those, and there's a couple practice problems related to that. The second principle that GAAP is based on is the cost principle. Which just says that we record items and keep them on our books for what they cost us, not necessarily for what they are worth. So if we buy a piece of land, we record that transaction for what it cost us, not necessarily what the market value is, or for any asset we would do that. The last two are a little odd, or it almost seems like you wouldn't have to say this. I guess they're not odd. Going concern assumption, which says I operate this business assuming that it's going to continue writing. I keep the long term in mind. I don't just assume this is a temporary 6-month kind of a thing. I think most business owners do that. And the other one is the monetary unit assumption, which means that I record my transactions in US dollars, not in, I don't know, chickens or something like that. So those seem pretty straightforward there. I think most people do that. Now, the accounting equation is fundamental to everything that we do in accounting, and this is going to work our way into what we're doing in the next chapter here. But the accounting equation says that assets equal liabilities plus owner's equity. Assets are things that we own, so cash, land, building, equipment, inventory, office supplies, anything like that that we own, that we have, cash being a big one. Liabilities are things that we owe, so this is debt. Most of the time, the accounts that are liabilities will have the word payable in the name, because if it says payable in the name, it means it's something that you will have to pay. It's something that you owe. It's a debt. I think the best way to explain owner's equity is to take this equation and rewrite it in a different way. So through the magic of algebra, I can subtract liabilities from both sides, and I get assets minus liabilities equals owner's equity. So what this says is really, if I take all of my assets and I sell them off and turn all my assets into cash, then I pay off what I owe, the liabilities. Whatever's left, that's the owner's equity. That's the value of this business to the owner, essentially. So whatever you have minus whatever you owe, that's the owner's equity. Owner's equity is actually broken down into 4 different types of accounts. So capital is the money that the owner put into the business. Withdrawals are money that the owner takes out of the business. And then we've got revenue is what the business earns for doing whatever it is it does, minus expenses. And that's the cost of doing business. Those are the costs that were needed in order to generate that revenue. So we can see that, let's change color. We can see that capital and revenue are positive numbers. Those are things that add to owner's equity. And then withdrawals and expenses are negative. Those are things that bring owner's equity down. But all 4 of those are part of owner's equity. So really we've got 6 different types of accounts. Assets, liabilities, capital, withdrawals, revenue, and expenses are the 4 different types of accounts. At first it'll seem a little bit foreign because you're not used to seeing these account names, but after a while they'll become much more familiar. So I want to do this problem. This is in the practice demo problems that you have. Those are those ones that are not part of your grade but are really good practice. So I'm going to work through some of those in here. This one says Kenmore Handyman Services has total assets of $16,400 and total liabilities of $8,680. Use the accounting equation to solve for equity. So it's an equation. As long as we know 2, we can always find the third, right? So we know that assets equal liabilities plus owner's equity. So we said that the assets are $16,400 and the liabilities are $8,680, and we want to find owner's equity. So we set it up like this, And now we can just use it like a little algebra equation. We want to isolate our variable over here. So we subtract the liabilities from both sides, and we get 16,4 minus 86,8 equals X. Therefore, X, or owner's equity, must be 77.2, or 77.20, sorry. And because of this equation, this side, the left side needs to equal the right side. So I need the assets, I need the liabilities and the owner's equity to equal 16.4. And if I know that liabilities are 86.8, the equity has to be 77.2. That's the only way I'm going to get the right side of the equation to come out to 16.4. Now the second part here says, if next year's assets increase by 3,500 and equity decreases by 2,580, what are the liabilities? So I'm really going to do it the same way, except I'm going to be solving for liabilities this time. So we're saying that assets increases by 3,500. So I had 16.4, I added 3,500, so that means my assets are up to 19,900. I'm going to be solving for the liabilities, right? And I know that the equity went down by 2,580. So 77.20 minus 2,580 means that my equity is now 51.4. So I've got assets equals liabilities plus owner's equity, and I'm solving for the liability. So again, if I set that up the same way I did before and put my variable on this side, I've got 19.9 minus 51.4 equals X. So that means X, I'm running out of room here, X must equal 14,760. So that's the number that has to go here so that this side of the equation equals 19.9. Okay? Alright, let's do one more like this one. Again, we're going to use the accounting equation to solve for the missing information. So here's my assets, here's my liabilities, and all four of these things, capital, withdrawal, revenue, and expenses, are part of my owner's equity. So I'll write the equation. I'm going to be doing the exact same thing I was doing on the last problem, except instead of just writing one thing for owner's equity, I'm going to write the four separate parts. So it'll be assets equal liabilities plus the owner's equity. So plus capital minus withdrawals plus revenue minus expenses. And these four things here, right, are the owner's equity. So assets are 42,600. Liabilities are 17,220. Plus capital of 26,240 minus withdrawals of 8,500 plus revenue of 12,080 minus X. That's what I'm trying to find. So I'm going to have X over here on this side, and so then I just do 42,6. I know this isn't how you say it in algebra, but I always think of it, you take, your number and you flip it over to the other side and it changes signs. Really what I'm doing is subtracting this from both sides, subtracting this from both sides, adding this to both sides, But, so you come out with 17,220 minus 26,240 plus 8,500 minus 12,080. So your expenses comes out to be 4,440. The last part of the equation says, or the part of the question, did they get a net income or a net loss? So net income or net loss, revenue minus expenses equals net income or net loss. So my revenue, let's put it over here, we have a little more room. Revenue is 12,080 minus expenses, which we said was 4,440. And so that means revenue is higher than expenses. So we have a net income of $7,440. If the revenue was less than the expenses, we have a net loss. So that's the accounting equation. We're going to build on that as we keep going here. Let's see. I think I'm going to stop this here and pick up with the rest of it in the second video so that it doesn't get too long. So I'll post this guy up, and then we'll pick up with there's 2 more things I want to show you in this chapter. Okay, I'll be right back.